All right, so today we're diving into something that might not, like, scream exciting on the surface.
Yeah.
But trust me, it's packed with ways to potentially save some serious cash
Oh, yeah.
when it comes to tax time. We're looking at IRS Publication 530,
Uh,
Tax Information for Homeowners, specifically the 2023 edition for those getting ready to file.
yeah, a lot of people kind of gloss over this stuff, but
Yeah.
this publication, it's like a treasure map
Okay.
to homeowner deductions. It really is.
So this publication, it's all about what homeowners can and can't deduct.
Right.
But it's not as simple as just like, here's the list.
Exactly. One of the first things they make clear is that to
Mhm.
actually take advantage of most of these deductions,
Okay.
you have to itemize on Schedule A of your 1040.
So it's not just automatically better to itemize if you're a homeowner.
Not necessarily. You really need to compare
Okay.
itemizing to taking the standard deduction. It really might be that the standard deduction actually gets you a bigger tax break,
Yeah.
depending on your income and your expenses.
Okay, so assuming we are itemizing,
Right.
what are some of the juiciest deductions this publication highlights for us?
Well, one of the big ones that a lot of people are interested in is that deduction for state and local
Right.
real estate taxes. But here's where it gets a little tricky.
All right.
There's a limit.
Okay.
You can only deduct up to $10,000 total
Oh, wow.
for state and local taxes, whether it's property taxes, income taxes, or even sales taxes.
Wait, so even if I paid like $20,000 in property taxes last year, I can only deduct 10.
That's right. That $10,000 cap was put in place a few years back, and it's been a hot topic ever since, especially in areas with those high property values.
Okay, so definitely something to keep in mind as we, go through all this.
For sure.
What about mortgage interest deduction? That one, it just seems so confusing.
Yeah, mortgage interest, that's another major one.
Yeah.
But the rules, they can be pretty complex.
Right.
A key thing to remember is that the limits on how much interest you can deduct, well, those depend on when you took out the loan.
Oh, interesting.
Yeah.
So like if I got my mortgage 20 years ago,
Right.
it's different from someone who, bought a house last year.
Exactly. This publication lays out all those dates and limits,
Okay.
but honestly, it can get confusing fast.
Right.
What's important is understanding that those limits exist and to really dig into those details for your specific loan.
Okay. That makes sense. So let's say I took out a mortgage, like this year, to buy my dream home.
Right.
Is all the interest on that mortgage deductible?
Not necessarily. There's a $750,000 limit on loans taken out after December 15th, 2017. But here's a little wrinkle.
Cool.
If you have an older mortgage, let's say under that $1 million limit for loans taken out before that date, right?
Right.
And you refinance after December 15th, 2017,
Okay.
your deduction limit on that new loan, well, it's reduced.
Oh, wow. So even refinancing can mess with things. Is there anything else I should be aware of with in this mortgage interest deduction?
Well, another important point is that the interest is only deductible if that loan was used to buy, build, or substantially improve your home.
Okay.
So you can't just go taking out a home equity loan to buy a boat and expect to deduct all that interest.
Right. So it has to be tied to the actual structure of the home.
Exactly.
Now, the publication also mentions something called points.
Uh-huh.
What are those?
Points are basically prepaid interest. So you pay up front when you close on your loan.
Okay.
And you can usually deduct these over the life of the loan.
Okay.
But there are some situations where you might be able to deduct them all at once in the year that you paid them.
Interesting. So if I paid, I don't know, $5,000 in points this year,
Yeah.
I might be able to deduct that entire amount on this year's return.
Potentially. But there are some pretty specific rules.
Okay.
It depends on things like whether you use the loan to buy or improve your main home, the prevalence of points in your area, how you account for them.
A few other factors.
Okay, so definitely worth digging into those details in the publication if points are involved.
Absolutely.
Now, so far, we've been talking about things you can deduct.
Right.
What about things you can't?
Yeah. It's important to understand what the IRS doesn't consider deductible.
Right.
Some common things people try to deduct but can't
Okay.
are homeowners insurance premiums, those pesky HOA fees,
Right.
most settlement costs,
Okay.
general home repairs,
Uh-huh.
and utility bills.
So those things are just considered personal expenses, even though they're, related to my house.
Exactly. The IRS makes a clear distinction between those expenses related to owning a home
Gotcha.
versus expenses related to just living in it.
Okay. I think that covers the deduction basics pretty well.
Yeah.
But this publication doesn't just focus on deductions, right? I remember seeing something about a mortgage interest credit.
You're right. And that credit can be a big deal for some homeowners, especially those with lower incomes.
It's tied to a mortgage credit certificate, or MCC, which you get from your state or local government.
So this is something you have to, like, apply for separately.
Absolutely.
Okay.
And it's not something you do last minute. You need to look into MCCs before you get your mortgage to see if you qualify and if they're even offered in your area.
Okay, noted.
Yeah.
What else does the publication kind of touch on?
Well, there's a whole section on the concept of basis.
Basis, okay. Refresh my memory. What is that again?
So your home's basis is essentially its value.
Right.
For tax purposes.
Got it.
It's crucial to track this because when you eventually sell your house, your basis determines how much profit you made, or your capital gain, and therefore how much tax you owe.
Right, right. It's starting to come back to me. So how do I, like, figure out my basis?
Well, that depends on how you got the house.
Okay.
If you bought it, your basis is generally what you paid for it, plus certain closing costs. But if you got it as a gift or inherited it, the rules are different.
And the publication breaks down those different scenarios.
It does.
Okay.
And it also talks about how your basis can change over time.
Oh.
Which is called adjusted basis. Things like home improvements or
yeah.
casualty losses. Those can affect your basis.
Okay, so basis is definitely something you want to keep track of throughout your, like, home ownership journey.
Absolutely. And that brings us to another critical topic that this publication stresses, record keeping.
Oh, yeah. You mean, like, keeping receipts and stuff?
More than just receipts. You need to keep records of everything related to your home and your mortgage, purchase documents, closing statements, improvement invoices, insurance records, property tax bills, you name it.
Wow, that sounds like a lot of paperwork.
It can be, but trust me, it's worth it.
Right.
If the IRS ever audits you, those records are your lifeline.
So organization is key.
Exactly. And this publication even gives you some tools to help with that. Table 4, for example, is super helpful for tracking those home improvements over time. It helps you stay organized and ensures you're capturing all the necessary details to adjust your basis correctly.
Well, it sounds like this publication is like a homeowner's tax Bible.
Yeah!
Is there anything else we should highlight before we kind of move on?
You know, one thing that really struck me was how this publication, it doesn't just lay out the rules.
Right.
It also encourages homeowners to be proactive.
Okay.
It points to other IRS publications that might be relevant.
Oh.
Like Publication 523, which is all about selling your home, and Publication 527 for rental properties.
So it's not just about understanding the basics. It's about empowering yourself to, like, dig deeper.
Yes.
And really take control of your tax situation.
Exactly. And
Right.
that proactive approach can make a huge difference in the long run, potentially saving you a lot of money and headaches.
I think that's a great note to end on for now. Let's take a quick break to let all of this soak in, and when we come back, we'll delve into some of the specific details of that mortgage interest credit and why those records are so important.
Sounds good.
Okay, so we covered a lot of ground on deductions.
Yeah.
You mentioned that this publication also, like, goes deeper on that mortgage interest credit.
Right.
What are the key things a homeowner should know about that?
Well, first off, you know, it's not something that everyone gets.
Okay.
You have to qualify.
Right.
And that usually means having a lower income
Okay.
and receiving what's called a mortgage credit certificate, or MCC, when you got your mortgage.
So this isn't something you can just, like, claim on your taxes out of the blue.
Right. You have to have that MCC.
Got it.
And you get that from your state or local housing agency.
Okay.
It's not from the IRS directly.
So it's kind of like a special program you have to apply for.
Exactly.
Okay.
And the publication stresses that you need to look into this before you close on your mortgage.
Yeah.
Yeah, don't wait till tax time and then be like, oh, I missed out.
Right. Right.
Yeah.
Makes sense. So assuming you do have an MCC, what does this credit actually, like, do for you?
It can be pretty significant, honestly. Basically, a portion of your mortgage interest, it becomes a dollar-for-dollar reduction of your tax bill,
Oh.
not just a deduction that reduces your taxable income.
Oh, so it's more powerful than, like, a regular deduction.
Definitely. How much you get depends on the terms of your MCC and your overall tax situation.
Right.
But it's something to pay attention to
Okay, noted.
if you qualify.
All right. Now, earlier you also mentioned how important, like, record keeping is for homeowners.
Yes.
This publication seems really insistent about that.
And for good reason.
Right.
You know, think of it this way.
Okay.
Your records are your proof.
Right.
If the IRS ever questions anything on your return,
So, like, if I'm deducting mortgage interest, I better have records showing how much I actually paid.
Exactly. Same goes for property taxes points, and especially if you're claiming that mortgage interest credit based on an MCC.
Right.
Yeah.
What kind of records are we talking about specifically? Just like receipts?
Receipts are good,
Okay.
but you need more than that.
Right.
Think about your closing statements from when you bought the house.
Okay.
Any paperwork related to refinancing,
Right.
records of home improvements, insurance policies, property tax bills, the works.
Okay, so basically anything related to my house and my mortgage, I should hang on to.
Exactly.
Wow.
And you need to keep them organized.
Right.
This publication actually has a table, Table 4, that's specifically for tracking those home improvements.
Okay.
It makes it easier to calculate that adjusted basis, which, remember, is crucial when you eventually sell the house.
Right. Adjusted basis. That's how much your house is worth for tax purposes, and it changes over time, like based on those improvements we just talked about.
Exactly.
Okay.
And without good records, proving those adjustments, it can be a nightmare.
So good record keeping equals peace of mind.
And potentially a lower tax bill.
Right.
You want to be able to claim every deduction and credit you're entitled to, and strong records are the key to doing that.
All right. Solid advice.
Thank you.
Now, before we wrap up, is there anything else about this publication that jumped out at you as being like particularly helpful or homeowner friendly?
One thing I appreciated was how Publication 530, it doesn't just stop with the info. It covers, directly. It points you towards other resources that might be relevant too.
Like what?
Well, it specifically mentions Publication 523, which focuses on selling your home and all the tax implications that come with that.
Right.
And there's Publication 527, which is all about rental properties if you're a landlord or thinking about becoming one.
So it's like this publication is the starting point, but it helps you kind of branch out.
Right.
And learn about other tax situations that could apply to you as a homeowner.
Exactly. It's all about empowering yourself to be a savvy taxpayer.
Right.
Understand those rules of the game.
I love that. Yeah. Knowledge is power, especially when it comes to our money.
Absolutely.
Well, I think we've covered a lot of ground on Publication 530.
Yeah.
But we've only scratched the surface of what a homeowner needs to know about taxes. Right?
True.
There's always more to learn.
Yeah.
But this publication gives you a solid foundation.
It does.
To build on.
For sure.
All right, so on that note, I think it's time for us to wrap up this deep dive. So we've spent this deep dive really getting into Publication 530 and what it all means for homeowners.
Yeah, we've really unpacked those deductions, talked about that mortgage interest credit, and really hammered home, just how crucial record keeping is.
For sure. But before we let you go, I wanted to loop back to something you mentioned earlier about how this publication, it points to other helpful resources from the IRS.
Right. It's almost like this publication is a jumping off point. It gives you the essentials, but then it encourages you, the homeowner, to explore further based on your specific situation.
I like that.
Yeah.
And one of the areas that it specifically highlights is Publication 523.
Yes.
Which is all about the tax side of selling your home.
That's a big one, yeah.
And whether you're planning to sell soon or it's, way down the road, understanding the tax implications is, crucial.
It's crucial because, it's not as simple as just pocketing the profit from the sale.
Right.
There's a whole tax side to consider.
Absolutely. Publication 523, it walks you through things like figuring out your capital gain or loss.
Yes.
Which, remember, is heavily tied to your home's basis.
Yeah.
And all those adjustments we discussed earlier.
Exactly.
So all that record keeping we talked about is going to come in handy big time when you're ready to sell.
It's essential. And Publication 523 also covers things like exclusions and exceptions that might apply to you, which can potentially save you a ton of money come tax time.
Yeah, I've heard about those exclusions, like you might not have to pay taxes on all of the profit if you've lived in the house long enough.
You're on the right track. There are specific rules.
Right.
But yes, there are situations where you can exclude a significant portion of your capital gains from taxes.
That's good to know.
Yes.
So whether you're buying, owning, or selling, the IRS actually provides a lot of resources to help homeowners navigate, like the tax maze.
They do.
It's not all bad.
They do. And Publication 530 does a great job of kind of introducing those resources and encouraging homeowners to take advantage of them.
Yeah, I think that's a perfect takeaway for our listeners.
Oh, absolutely.
Don't just rely on what you think you know about taxes.
Right.
The IRS puts out these publications for a reason. They're packed with valuable information.
Yes. Take the time to read them, understand them,
yeah,
and use them to your advantage. It can make a real difference in your financial well-being.
I love that. All right, so on that note, let's wrap up this deep dive with a little something to ponder.
Okay, sounds good.
If you could make one home improvement solely for the purpose of getting a tax deduction, what would you choose and why?
Ooh, that's a good one. That really makes you think
Right?
about the strategic side of homeownership and how those decisions can really impact your taxes down the road. It's
Yeah,
all connected.
it is.
Well, we hope you've enjoyed this deep dive into IRS Publication 530.
Yes.
Remember, knowledge is power, especially when it comes to taxes.
So stay informed, stay organized, and until next time, happy